Welcome to Everything Financial Radio. I'm your host, Dennis Tubbergen. This is the Legacy Radio Network. Glad you're with us today. Another eventful week in the markets just passed, and we're going to be talking momentarily with a returning guest to the show, Mr. Mish Shedlock. And Mish is an economic commentator, very prolific economic commentator, and a very bright guy. Glad to have him back. A lot of responses last week, people asking for a copy of my new book, Economic Consequences. You can get a complimentary copy if you'd like at economicconsequencesbook.com. That's economicconsequencesbook.com. Just enter your information. We'll be glad to send you a complimentary copy. Glad you're with us. You can also check out our discovery groups. You can go to personallegacyseminars.com and see when we might be in your area, and look forward to seeing many of you at those discovery groups. On the phone with me today, Mr. Mish Shedlock, as I said, economic commentator of prolific proportions. Mish has to spend just about every waking hour reading and analyzing, and very glad to have him with us once again. And Mish, thanks for joining us. Know you're a busy guy.
It's a pleasure to be back on the show. Yes, I'm busy. I often spend 14 hours a day reading, writing, thinking about the financial markets. What's it all mean? What's it mean for the stock market? What's it mean for the U.S. economy? What's it mean for the global economy?
Well, Mish, and that's exactly what we want to talk about today. And I was reading some of your work recently, and you talked a lot about inflation and deflation. And I'll tell you, talking to clients now and talking to people that are, in general, worried about what direction is the economy headed, what will that mean for my own personal finances, they're concerned about the Federal Reserve printing money, maybe leading to a highly inflationary environment. They're also concerned that potentially we could see this deflationary environment continue and even intensify. And I know you've thought a lot about those topics. So give us your take, given the current state of the U.S. economy and your estimation as to the actions that policymakers might take, if anyone can imagine such a thing. What's the outcome? What's your take?
Well, currently we're back in deflation. I made the call. I did a post called Yes, Virginia, U.S. back in deflation. Hyperinflationists are wrong twice over. Everyone looked at all this printing of money that the Bernanke was doing, the Fed was doing, actually that the global central banks are doing, and it's certainly not causing inflation here in the United States, although it is causing inflation in China. And the reason for the difference is credit is expanding in China at 30% a year. They're building houses, real estate, railroads, entire cities, in fact, that go unlived in just to maintain employment. When you do that kind of malinvestment, you see the same kind of action like we saw during the U.S. housing bubble. Housing prices, real estate prices are very inflated. I think China's going to crash. Also, think about the demand for the commodities coming from China when they're building all of these cities, railroads, and airports that literally no one is using. The demand for commodities from China is currently very high. That's picking up, causing the prices of commodities to rise, and it causes all the hyperinflationists to point and say, oh my God, look at this. Well, yes, this is a result of what China's doing, not what the result of what is happening here in the United States. In the United States, we see Bernanke trying desperately to get banks to lend, lowering interest rates. They're at record low rates here on the 2, 3, and 5-year treasuries. The 10-year is about at a new record low. You know, that's not a symptom of inflation. That's one of the symptoms of deflation. And I did a post that I just referred to, the U.S. back in deflation, where I looked at 15 symptoms, and 14 of those 15 says the U.S. is back in deflation. But before we can talk about this, I mean, everyone's going to hop in and say, Mish, you're a nut. You know, the prices of everything I buy is just going up, up, up. Well, the price of houses is not going up. But we need to have an accurate definition of what inflation and deflation are. And when I say the U.S. is back in deflation, I'm using my definition, and it's the one that the economy is working to, which is inflation is an increase in money supply and credit, and I mark credit to market, and deflation is the opposite, of course. A contraction in money supply and credit. Now, it's interesting to know here that back in 1957, the Merriam-Webster definition of inflation was an increase in money supply. Somehow, the Fed governments have managed to change that definition over the year to talk about price increases. Now, why would they want to do that? Well, it's because the Fed is responsible for inflation. It's the Fed that's responsible, and fractional reserve lending that's responsible for the increase in money supply. But, that money supply doesn't cause massive price inflation unless it's working its way into the markets. So, that is, without a doubt, the way the real economy works. And people say, well, all I'm concerned about is what the prices are. And I say, well, if all you're concerned about is prices, then you're concerned about the wrong thing. If banks aren't lending, if credit is not expanding, then businesses aren't hiring, defaults are soaring, foreclosures rise, bankruptcies rise, bank failures rise. Those are all the things that we've seen. Those are a direct consequence of deflation, and those are the things that matter far more than the price of a bunch of carrots going up $1 to $2 or whatever the price of carrots have gone up. I look at meat prices; they're a little bit higher than they were 10 years ago. Literally, I'm talking about sale prices here. So, and I look at the price, say, of prime rib. It was on sale about $4.99 a pound 10 years ago, and now what is it, $5.99 a pound? So, there's just not a lot of inflation in price inflation in some of the goods that people are complaining about.
Well, if you're just joining us, we're chatting with Mish Shedlock. This is Everything Financial Radio. I'm your host, Dennis Tubbergen, and this is the Legacy Radio Network. Glad you're with us. And Mish, when somebody out there, let's say that you've got somebody that's retired, they're an investor, they have a nest egg. Let's assume the Federal Reserve in the United States opts for QE3. They print more money. Mm-hmm. Will that action in and of itself be inflationary based on your definition? Then a follow-up question, will we see the price of that bunch of carrots you were talking about go from $2 to $3 a bunch? What's your take?
I don't know about the price of carrots going from $2 to $3 a bunch. But what would QE3 do? In my opinion, nothing. When maybe spook the markets for a day or two, maybe even crash the markets. In fact, instead of having them rise, when the Bernanke Fed instituted QE2, U.S. interest rates on the 10-year Treasury were something like 3.5%. Now they're 2.2%. So, what's it going to do? Push 10-year yields down to 1.75% from 2.2? What good is that going to do? If interest rates falling from 3.5 to 2.2 didn't do much for the economy, what is driving the yield interest rate lower do? I mean, Japan went through these exact things for 20 years, and interest rates are at preposterously low levels here, based off of, what one thinks is happening to prices, across the entire gamut of nations, including the U.S., the UK, Japan, and Germany. I did a little post on that yesterday, too, showing comparative rates. The yield curve is extremely flat for the first 3 years, and all of them, we're talking roughly 0% interest rates. And what's happening? We've got global growth approaching zero. Germany's in contraction now, unexpectedly yesterday. GDP rose 0.1%. So, and think about all the austerity measures that are coming in Europe. They're coming in France. They're coming in Italy. They're already in Greece, Spain, and Portugal. That's going to slow the European economy. That has to impact the U.S. economy. And China slowing, and it is slowing, is going to impact the Australian market, and Australia is already in a bubble that's imploding right now with a housing bubble. I think Canada's in a housing bubble, and that's going to implode. Central bankers are desperate to stop this,